This is the cash flow statement lesson. The information is on page 743. It's the illustrated problem. So turn to page 743. The cash flow statement has three sections: operating, investing, and financing. Let's get started with the operating section. The operating section contains basically information from your income statement and then the current assets and current liability section of the balance sheet. We are also be aware of the given information on page 744. We're getting a lot of information from the income statement. Y'all are savvy readers of financial information now, so look on your income statement, page 744, and pull out the net income. That's going to be the bottom line, $98,500. Then search the income statement for your depreciation and amortization expense. You should see that there. Depreciation of $23,500 and amortization of $7,000. The next thing you need from the income statement are any gains and losses. You'll see a gain on sale of investments for $11,000. So those are all items you'll need. Also note that sometimes in your homework problems you're not given an income statement, and so you don't know your depreciation expense. Note that you can always back into it by taking the difference in the current and previous year's accumulated depreciation, which is found on the balance sheet. That's assuming there are no disposals during the year. Okay, they also give us other information down there, A through E. We'll look at that information as needed. So back to the operating section. We're going to need a lot of information from that income statement. You start with the net income, and then you subtract any gains, add back any losses, and then you add back your depreciation and amortization expense. Let's see what that looks like. For our operating section, we would start with our net income, and then we subtract a gain on sale of investments. Gains and losses are accounting entries. We're dealing with cash, so we want to negate any gains or losses, zero it out, so that we can pick up the cash in the other sections, generally the investing sections, where we're going to pick up cash from transactions of items that are sold. So since we had a gain of $11,000, we're going to subtract it. Had we had a loss, we would have added it. The next thing that we do in the operating section is to add back any expenses that were subtracted in arriving at net income that were non-cash. Depreciation expense and amortization expense will always be non-cash items. Remember, the journal entry is debit depreciation expense, credit accumulated depreciation. No cash is involved in those expense entries. So we're going to add both of those back. The next part of the operating section is dealing with current assets. We look back at our balance sheet and we see our current assets, other than cash, are accounts receivable, inventory, and prepaid expenses. So we're going to look at those one at a time. Our accounts receivable actually went down this year. In 2011 it was $102,300. In 2012 it was only $95,000. If accounts receivable decreased, that meant people were paying me what they owed me. So I'm actually going to add that because my cash increased. People paid me. Cash went up. Inventory is the next current asset. Inventory has increased $7,300. It went from $157,900 to $165,200. If I am building up my inventory, I am paying cash out. So my cash is actually going down if my assets are going up. Same thing for our prepaid expenses. Prepaid increased, so I must have purchased maybe additional insurance. If I purchased something, then my cash went down, so I'm going to show that as a decrease. You can always remember that assets are opposite. If they increased, then you subtract them. If they decreased, you add them. Okay? Think about it one more time so it makes sense in your head. If accounts receivable decreases, that means people are paying me. My cash goes up. I added. If accounts receivable increases, that's people not paying me. So ultimately my cash is going down. I'm not getting cash. Okay, current assets we've taken care of, so now we look at current liabilities. On the balance sheet, we look at our current liabilities: accounts payable, accrued expenses, and income tax payable. You'll also notice dividends payable is a current liability. But dividends is part of equity, so that's going to be down in the financing section. So never include dividends payable as a current liability in the operating section. So I'm doing the same thing. I'm going to look at my accounts payable. It actually went down. If I am paying off debt, what is my cash doing? It is decreasing. So I'm going to subtract the amount that my payables went down by. Look at our accrued expenses. Okay, they actually increased. So those are expenses or payables that I'm not paying. I'm keeping my cash. So I get to add that. Cash was saved. My income tax payable last year was 84 and I paid it down to 79. So if I paid down debt, once again my cash went down. You can remember liabilities are like. If they increase, you add them. If they decrease, you subtract them. Once again, make sure it makes logical sense to you. If my accounts payable decreases, I'm paying off debt, cash goes down. If accounts payable increases, that's cash I am not giving up, so my cash increases. And there's your operating section. Cash flows from operating. When you add and subtract all the numbers we've just spoken about, you get 115,120. Yay, that was not so bad, was it? Let's move on to the next section, which is investing. The investing section consists of anything in the long-term asset section of the balance sheet. Basically, you should put a check mark by everything on your balance sheet, so it's all taken care of by the time you do your cash flow statement. Now we're taking care of investments, land, building, machinery and equipment, and patents. So, once again, I look at the changes in the assets. In the other information, Part A, they told us land costing 15 was sold for 15. So we didn't have a gain or loss on it for accounting purposes, but for cash purposes, if we sold something for 15, what did we get? We got cash of 15,000. So for our investing section, we're going to put add proceeds from sale of land 15, because we received 15 in cash. So I'm looking down at my other assets down here. The next one that I see is building. Again, in the other given information, they told us that a building that cost $115 was constructed. Basically, we purchased a building. If our building was purchased, what did our cash do? Our cash was paid out. So we're going to put purchase of a building, a negative $115, because cash was paid out for that. The patents, I just want to make a note here, the patents also decreased by $7,000, but that was the amortization. You have to kind of remember that when you debit amortization expense, the credit goes directly to the patent account. So we've already taken care of our patent. We've taken care of our land, our building, our machinery and equipment did not have a change this year, so it's taken care of. So the only one left to deal with is investments. To figure that out, we're going to have to do a little bit of detective work. Clue 1 is from the income statement, we know we had an $11,000 gain from the sale of investments. Okay. Clue 2, we can see that from our balance sheet that our investment account decreased by $49,000. Okay. So then we can deduce. When we sell an item, we get it off our books or decrease the asset by cost. So we know our asset cost us $49,000. So the investment we had, because it decreased, cost us $49,000. We sell something for a gain, that means we received more cash than the asset cost us. So we can then deduce that our selling price of the investment was $60,000. If that had been an $11,000 loss, we would have subtracted the 49 from the 11 to get the actual cash proceeds. So now that we know the cash proceeds, we're going to put it on the investing section, proceeds from sale of investment. So now we've got the investing section done because we have taken care of all long-term asset changes. Yay! Let's move on to the financing section. Financing is long-term debt and equity transaction. Equity would be dividends and any stock transactions that are cash. So, We look at this first one, and we see that bonds payable went down, and we also see 2,500 shares of common stock were issued at $40 in exchange for bonds payable. So if 2,500 shares were issued at $40, that would be equivalent to 100,000. They tell us that those were not issued for cash. Do you see that they were issued in exchange for bonds? So our journal entry would have been to reduce our bonds payable, debit bonds payable, and credit our common stock. Is cash involved in this journal entry? No. So we've taken care of the change in bonds payable and the change in our common stock, but no cash was involved, so we're not going to write it down in our section. So we're going to move on. Mortgage note payable due 2023 went from 0 in 2011 to 40,000. It increased. Why did our mortgage go up? Mortgages go up because we borrow more money. If we borrow money, what is our cash doing? Increasing. So for our financing section, we're going to write down that we received cash from our mortgage of $40,000. Okay, let's look at all our long-term debt and equity accounts one more time. We see that the mortgage payable we've taken care of. We borrowed money, so cash went up. The bonds payable went down, but that was because we exchanged it for stock. And then our stock went up because we exchanged it for bonds, so those negated each other. So the only thing we're left with is the information that they told us that we gave dividends this year. So if we paid dividends, our cash went down. So now we finish up our financing section. You're done. You've done all three sections. This is what the finished product looks like. Your operating section was first with $115,120, and then you had cash flows from investing and financing. When you add your three subtotals, your operating activity of $115,120, your investing, you subtract $40,000, your financing, you subtract $36,770, you get that cash increased $44,450. That's your check figure down there. That's what cash increased by from 2011 to 2012. To finish off your cash flow statement, you just write cash at the beginning of the year, which was your 2011 balance, and that equals cash at the end of the year. So you know you did the statement right. So that's cash flow in a nutshell.